Thanks, Eric. Hi, everybody. Good morning. Great to be here. Thanks for the invitation to the Valek family. I'm having a good time. The only thing is, it's very difficult task to talk only 18 or 20 minutes. So I really skip the rest. Just please excuse my accent because it's kind of a weird accent, perhaps from Arnold Schwarzenegger. He's a very good representative of Austria, or not. And I'm actually just had a conversation, so I have the accent of Arnie, and I look like a French actor apparently. So I don't know who knows this guy, but I can perhaps tell you afterwards bilaterally who that may be. So let's just jump in there. Really short. What do? We are authors of the In Gold We Trust report. So Incrementum is a owner-managed asset manager in the Principality of Liechtenstein. That is not Luxembourg, but that's fine. Ronny Störfli, who was here, and myself, we are the authors of the In Gold We Trust report. It was called the Gold Standard of Gold, researched by the Wall Street Journal, which was quite a compliment, I guess. And we really focus on a holistic approach. What we are looking for is not like perhaps the typical supply and demand analysis. It's more like we try to gauge the whole financial system, which is obviously quite a task. But I think one wants to really think about the big picture if one tries to evaluate gold, and if one wants to look out if there's perhaps a bigger move, like in the hundreds or perhaps even someday in the thousands of dollars, up or down. So that's basically what we do with In Gold We Trust report. Next edition will be released on June 1st, 2017. Just Google it if you're interested, and I'm sure you have some fun reading that. So, where are we now? The current perception of financial markets, equities are saying, in Trump we trust. So we just have this huge Trump rally continuing the big bull market of US equities starting after the big financial crisis, 2008, 2009. It actually just saw one direction in the market, especially the last 12 to 18 months again. Volatility is low, so the perceived risk is extremely low. You can see this on the VIX index, for instance, but also other indicators display this. So what happened now, and what's the big topic now, is the normalization of rates is finally on the way. These three errors which I put in here, what do I want to point out here? These errors point to the points of time where the interest rate policy apparently started their tightening. Well, this first error is the announcement of tapering. So that was in May 2013, June, that is. This one is about whether the tapering was finished. So the last QE program actually was ended, and the third one was where the first interest rate hike, after I think by then more than 8 years, took place. And this phase, I think, is quite an interesting phase for the development of the gold price, because you had obviously the bull market continuing here until 2011, 2012. But then this severe bear market we all went through. And this, I think, is one of the reasons that there was this perception that we're entering this normalization period and the hiking period again. Very interesting, though, if you look at the gold price. So these errors were like during this time. So what are these errors supposed to show you now? These errors are actually the points in time when you had the three real interest rate hikes. And after each of those, and this one is, I'm sorry, not quite outdated. It's a little bit outdated, a few days, but we are, I think, close to here. So even after the last interest rate hike, just last week, we every time had a bullish reaction from gold. So how do we read this? So this is for us a big sell the rumor, buy the fact trade. So sell the rumor of interest rate hikes or of tightening, which we saw during these periods, and now we have the facts. Well, the actual interest rate hikes, pretty small hikes if you ask me, and pretty late hikes, but very interesting that gold is reacting that bullishly. We actually were kind of anticipating a bullish reaction also in rising interest rates in our last gold report in June. And that's what's seemed to be been happening. So that's, I think, quite a bullish sign generally for the gold dynamics. So just to the name of my talk. So what is a black swan? I guess who from the crowd knows the Black Swan, the book? I guess most of you. So a gray swan. So just from Wikipedia, what is a black swan? The disproportional role of high profile, hard to predict and rare events. That's like the first definition point of a black swan. So a high profile, hard to predict and rare event. So what I'm going to talk about now, just very briefly, is not quite such rare events. At least one shouldn't, in our view, consider them so rare. So that's why I'm calling that gray swan. And even though in this matter of time they probably are high profile, hard to predict, and will probably have a big impact on the markets. And these are only three. I mean, this is not the only three definitely that exist, but I'm just going to line out three of them very shortly now. So which three gray swans could really impact the gold price significantly? I'm sure you all can come up with various scenarios where we will have a big reaction in the gold price, but I just want to point out they probably aren't that rare events as they are perceived by the market right now. So gray swan number one. Can Trump prevent a US recession? Or rather, perhaps one should ask, how long can Trump prevent a US recession? So everybody's talking about Trump, sure. I mean, it's a big market mover. Don't want to talk too much about him because, yeah, it could go on for hours probably. But just look at the economic expansions of the US since World War II. And first of all, what one can see is this one is the most shallow expansion, and it is actually getting to the point that it's the third, just shortly before the third longest economic expansion. And as we all have witnessed, and in, most of the modern history always proved, we just have to live through these economic cycles. So in my mind, in our mind, a recession should definitely not be a black swan. It's definitely nothing nobody should expect sooner or later. And if you just take a look at this, I think the longer we keep going, the more the likelihood rises that we actually see a US recession. Well, I mean, what could potentially be the reaction, say, for instance, from monetary policy towards a US reaction? I think that's pretty easy one. I mean, they only have one medicine, and that's printing money, if you want to put it like that, or if you just want to say it differently, it's like decreasing interest rates. There's not much leeway for that, unfortunately, or quantitative easing. We saw that picture, we saw that movie, and I'm really convinced that it will replay, and actually that's also what the officials are telling us. So really no secret from the reactionary side. Just to briefly touch on that. It is very often compared now, the Trump administration, to the Reagan, potentially to the Reagan administration. Takeover from a Democratic Party and more pro-growth and so on. I think there are some fundamental differences between Trump and Reagan, and even that we wrote in the June Gold Report, where we wrote about it, that it's much more probable that than generally perceived that Trump actually would do it. However, the Reagan boom, what happened first when he took over, you had these double dip recessions, and you had actually in 1981, 82, one of the most severe recessions, and if I'm correct, was the most severe recession since the Great Depression, actually, back then. So you first had to have a big recession, and which cleansed the system kind of, and also you had a completely different environment in terms of interest rates and in terms of inflation. So you had a high inflationary environment coming out of the 70s and a high interest rate environment. And what happened is Volcker, after raising the interest rates, was able to lower them significantly, and obviously also this policy was continued by his predecessor, Alan Greenspan. So this Reagan boom, first of all, happened after a big recession and in an environment of falling interest rates and falling inflation. Definitely don't have much leeway for falling interest rates now, and also not much leeway for falling inflation. Talking about inflation, just one more remark on this slide. These interest rate hike cycles, also that's no secret, I guess, most of the time are perceived by, these recessions are most of the time perceived by hiking cycles. So also this is a very small hiking cycle still, which we are now witnessing, but hiking cycles most of the time weren't that good news for the economy in the medium term, especially when they came with a rising inflation environment. And also this we may be seeing now. We're definitely seeing increasing CPI numbers in the US and all over the Western world, actually. If we're going to reverse here, I don't know, but I think this is something which one has to watch out very, very closely, because if this continues and if the rate hike cycle continues, the likelihood of a recession increases more and more. So gray swan number 2, will a strong US dollar trigger financial havoc? And if you take away one thing of this presentation, perhaps it should be the significance of this chart, or of any dollar index chart. So this is the Dixie index going back to the 70s, and you have the three big bull markets, to the mid 80s, the strong dollar, to the 2000s, and now once more 2015 to now 2017. We heard in the morning already from Claude, he's not a big dollar bull, if I'm not if I understood him correctly. Personally, me neither. However, there is a scenario and a case to make that we could see even a stronger dollar in the short term. I think the recent weeks for me look like this could have been the peak. So we have down below 100 in the Dixie index, which is a big number, obviously, and also technically, I think it looks as if this trend is broken, and I think this is for commodity investors, perhaps obviously apart from the spot price of your commodity, the biggest macro factor which you should monitor. So if we really see a downtrend evolving here, I think this is like the best environment commodity investors can just hope for. However, a strong dollar, which I'm talking about here now, a stronger dollar, I think is kept to some extent. Why? This is also a very interesting chart, if you ask me, because this is the 30 months change of the exact chart we just saw slide before. If you have too fast of a rise, a strengthening in the dollar, it always has triggered some kind of crisis. So I think just by that, this potential of triggering some kind of emerging market crisis or some kind of a crisis of any dollar debtor it's a very likely scenario. So that's why the question is, will it get stronger before it gets weaker, or is it already on the fall? That's also perhaps for these people who were attending the dinner yesterday my answer to the question I asked. I'm more in the inflationary camp, definitely. But if you see a rising dollar, you could see deflationary in the medium term or in the shorter term. But that's how I view. I think we're going down, but perhaps we're going up and then going down. Gray swan number 3, and that's third and last swan, which I'm talking about. It's could we soon enter a highly inflationary environment or even a stagflation? Nobody, I think, is thinking about the stagflation. US was in the stagflation in the 70s. Not many people were active in the business in the 70s already who still are active now. I definitely wasn't, but I mean, I read a lot about it, and I think most of the asset managers just don't even factor in such a scenario. If you have like multi-asset portfolios, you go back and perhaps back test the environments which you had 10 years ago, 20 years ago, 30 years ago. Is quite a long environment, but most of the guys don't even go back to the 70s. If you go back to the 70s, the classical portfolio, the classical investor holds 70% bonds, 30% equity, something like that. It's devastating environment for that. So that could be the big losing trade for every classically mainstream investor if we have a stagflation or even a high inflation with some growth. Just shortly, just wanted to point out how fast actually the inflationary environment could change, or historically did change. And it's just in a matter of 2 years, we have from 1915 to 17, 45 to 47, or 72 to 74. Each time, huge increase of inflation rates. So it really could potentially go faster than one expects. Well, then again, you could argue, well, these were special times. You had world wars, and you had here big wars and oil shocks and so on. So you really can't compare that to now. Well, that's true, but I would make a counter argument to that one from the debt point of view, which is basically the trigger after a war. You're most of the time in debt, and that's the trigger for this monetary policy. You want to go down and you want to lower your debt, at least in real terms. So from a debt point of view, it's not that dissimilar. After World War II, for instance, the US was in similar debt situation than like now. So I think it's not so far-fetched a comparison. So this could be a gray swan. Shouldn't be that rare event. It's perhaps rarer than a recession or historically, but also not completely out of the blue, if you ask me. How am I time-wise? Yellow cards. Okay, this is very short. Will be interesting to see if the next recession hits. If we again see a strong dollar, or perhaps this time we see a weak dollar, which also could happen. Normally, the last decades we always had the U.S. recession with a strong dollar, but now perhaps. If we lose faith in this monetary policy, perhaps we could see falling dollars, perhaps similar to to 86, 87, and this could perhaps lead to stagflation. So watch out at the dollar chart. What would these gray swans mean for gold price and the mining stocks? I think that's a pretty easy one. Just very shortly, what happened during the times of recessions since the 60s? All pretty nice returns. Perhaps not so nice at the beginning of the 80s, but then again that was coming down from this high inflationary, high interest rate level. But it was always for gold actually quite a good environment. And especially also the times afterwards was great performance. Mining stocks, last chart. The party has just started. We've plotted all the mining bull market since 42, and we are here. So I mean, doesn't necessarily have to go this way, but historically it just did go this way. So I think we're very early in the game. You could make the argument that this time, yeah, this will be even bigger, but just, I don't know if it's gonna be much bigger, but just that's the history. So I think the sector will prosper. I think this conference will get bigger and bigger in the next years. So I'm happy to speak again, and thanks for my time.